or make payments on that account a few days before they actually report. A lot of times this can increase your credit score dramatically very shortly. A couple of don'ts. I do not recommend opening finance company accounts. I don't recommend opening any new credit cards before a new loan. I don't recommend opening small home equity lines. And I don't recommend closing credit card accounts. And if you have collections, don't pay them off before you get a new loan, especially if you're going to get a mortgage. I wouldn't pay those collections off before the new loan.
Okay, Jim, can you explain to us what a finance company account means?
A finance company account can be looked at a couple of ways. Let's say you go into Best Buy and you buy a TV, 24 months no interest. That would be considered a finance company account. It's not a traditional revolving line of credit. You go in and you cut a deal and then you pay it off. Or let's say you go to a truck company accessory store and you want to buy a bedliner for your truck. It's $1,000. You don't have the cash. You don't have a credit card, and they finance it for you. That would be considered a finance company account. Now, they're looked at negatively in certain cases. If you have an overall good mix of credit, let's say you've got a mortgage and you've got 4 or 5 credit cards and you've got an installment loan for an automobile, and then you have a couple of finance company accounts, probably not going to hurt your score. But if that's all you have in finance company accounts, that would be a negative.
Especially, I guess, if you're just establishing your credit.
Correct.
Okay.
Correct.
Okay. And can you talk a little more about paying off the old collections before a new loan? Because it would seem like if you're told sometimes to pay off that collection account before they'll make the loan, that you're in a dilemma.
Yeah, and I should have explained that better. What happens is, let's say you've got a collection that is 3 years old. So you have an account that we're delinquent on, and that account holder got tired of chasing you, so they sold that paper to a collections company. And now the collection company is just chasing you for that money. So that happened 3 years ago. Now, in credit score modeling, they're only looking at the last 2 years. So your score only reflects the last 2 years. So this thing is 3 years old. So even though it's still in your account or in your file, it doesn't negatively affect your score anymore. So let's say you're going to buy a house in 6 weeks, and you know you have to pay this collection off. Well, if you go ahead and pay it off now, what that does is it starts the time clock all over again. So it looks, according to the credit reporting model, it looks like that collection just happened. And it's very recent, and that can really hurt your score. So what I would recommend doing is telling the collections account holder that you're going to pay that account off at the closing table. And then arrange it with the closing attorney that you're going to bring a check for that collection. He's going to actually close the loan, and then he's going to pay off that collection right then. So that way your credit's not re-pulled. It doesn't show that, and it doesn't hurt your score. So that's what I would recommend.
I got it. And the one right above that about closing your credit accounts, it would seem logical that if you're not using something anymore, to close the credit account would be the best course of action, and you're saying not to do that.
I don't recommend it because, especially if you're going to buy a home, let's say you've got 4 credit cards, you're only using 2, and those 2, because they have excellent APR rates, they're the only ones you use, but you've got like 60% debt ratios on those cards. Well, the other ones you don't have any on, and you may have $5,000 balances available credit with this, so you got $10,000 worth of available credit you're not using, which offsets your overall ratio. You have to have credit ratio, so you actually look good. If you close those 2 accounts you're not using, all of a sudden you don't look so good anymore.
I see.
That's why I don't recommend it, especially right before you're going to do a mortgage.
Got it.
We'd never do it before if you're getting ready to do a mortgage.
So we really just need to understand how they calculate it and follow their rules, even though it doesn't always make logical sense.
It doesn't make sense a lot of times, but you have to know the system and you have to play in that system. Another thing also would be a small home equity line. These credit reporting models, anything below $25,000. Say you have a home equity line that's $20,000. They look at anything below $25,000 as an installment loan. So even though it's a home equity line, that's technically a revolving line of credit. They don't look at it like that. So, and what typically happens in installment loans is you borrow a certain amount of money and then you pay it down every month and you pay it off. But in a lot of cases, home equity lines are there to eliminate mortgage insurance, and it might be an interest-only mortgage. So they may not make payments, pay down that amount. They may just make interest payments every month, so the balance stays the same every month. So 2 years down the line, you've got the same balance, but the file says you should have paid off this much, so it may hurt your score. So I wouldn't recommend opening up small home equity lines when you absolutely have to.
But if you have a larger home equity loan, that doesn't come into play.
It doesn't come into play.
Got it.
Okay, and as always, if you're having problems, your score is not where you want it to be, time is going to be your best friend. If you start doing, the dues part above, over time you're going to notice a marketable improvement in your score. So I would just say, do your best, to start paying your bills on time. Do your best to get your balances below 33%. Try to stay away from, the don'ts, and before you know it, you'll have your score where you want it. So that ends the webinar presentation, and I'd love to take any questions.
Okay, Jim, we have a few questions coming in. The first one is, I just ordered my credit report for the first time and want to make sure that everything is accurate. Can you tell me the most common errors you see in credit reports?
Yeah, I'd love to, and that's a very good question, because I believe that knowing what to look for can really save you a lot of headaches in the future. Probably the most common error that I see is confusion regarding family members with the same name. A really good example of this actually happened to me and my dad. And I'm Jim Young Jr., and my dad is Jim Young Sr. And about 4 years ago, my dad purchased a second home up in North Carolina in the mountains. And when he went to get his mortgage, they pulled his credit, obviously, and they found that 2 of my credit card accounts were on his report. Now, it was fairly easy to get that, we disputed it and got it taken care of fairly easily, but we see that a lot. So always look for those type of things, especially if you're a junior or a third. You may see your dad or your son's stuff on your report. I'd also look for incorrect accounts. These are accounts that you don't recognize. In many instances, this is simply a case of mistaken identity, like with my dad and I. But it can also be a red flag for identity theft, so you need to make sure you're looking for those type of accounts. A lot of times we see that the credit line limits are wrong. It's very important you confirm that the credit limits listed for each of your accounts match the information on your billing statements. This is a common error, and unfortunately this error can really hurt your score negatively because it can mess with your debt ratios. And probably another one would be original account dates are wrong. Time is your friend, like I stated, with credit report scores. And the length of time that you've had open accounts in good standing is a key factor in scoring. So make sure these dates are accurate. This error typically occurs when the account servicing rights are sold to another company.
Okay, we have another question. I am on a limited budget due to income restraints, so I am having a tough time reducing my credit card balances. I know that debt balances to available credit limit ratio is important to my credit score. Is there a way to improve my ratios without necessarily reducing my debt balances?
Yeah, I see this a lot too. And obviously, the most effective way to improve your ratios is to pay down account balances. However, in your case, it doesn't seem possible. So, like I stated earlier, I would recommend asking your current creditors to increase your available credit limits if possible. And if they agree, this will definitely improve your ratios, which will bring up your credit score. But if they do increase your limits, you need to be diligent and make sure you don't use that available credit, because you'll find yourself right back in the place you started.
This is an interesting question. I recently reviewed my credit report and found an account that I did not recognize. This account appears to have been closed a few years ago and indicates no activity or late payments. Should I dispute this account or simply not worry about it since it's been closed?
Yeah, I see this a lot too. While that account is most likely a case of mistaken identity due to the true account holder's name or social security number being similar to yours, I would still recommend having it removed immediately. One of the potential issues that you could, one of the potential issues to you could be that the true account holder decides to reopen that account and is delinquent on the payments. And this would obviously cause problems with your score down the line.
Okay. One more question. I recently applied for an FHA mortgage loan, which I think most people are doing these days, but was denied because my credit score was too low. The 3 credit reporting agencies had my scores at 657, 629, and 622. I did some research on FHA guidelines after my denial and found that FHA requires a minimum score of 640 for approval. Since my top score is 657, I'm confused as to why I was denied.
Yeah, another good question that comes up quite often. In today's mortgage underwriting environment, guidelines require lenders to use the middle score when assessing a person's creditworthiness. Now, since your middle score is 629, FHA automatically denied your application. So what I would recommend doing is analyzing your credit report to find out where the differences in the scores have occurred. Like I stated earlier, some of your creditors may report to one, two, and not the other, or just to one agency, and that might be an issue. Some of the agencies that have the lower scores may have errors in some of your accounts. That might be the reason that they're below the top score. So you need to make sure you're looking at all 3 reports and make sure there's no errors there. Other than that, make sure you're making your payments on time, and you'll get there eventually.
Okay, I believe this is our last question unless we have another one come in. I divorced my husband 2 years ago and want to purchase my own home. In my divorce settlement agreement, he was responsible for paying off the car and 2 credit cards that were in both of our names. I just recently discovered that he has been delinquent in those payments and it has hurt my credit score. Is there anything that I can do?
See this often too. Unfortunately, there really isn't anything that can be done in this situation to help your score. What you can do, and what I recommend you doing, is submitting a 100-word explanation of the situation that will show up on your report. So any future creditors looking to extend credit can look at it and understand what happened to you. But unfortunately, that explanation will not affect your score up or down. This brings me back to some news on helping your credit report. If you do go through a divorce or getting ready to go through a divorce, it's very important that even if your divorce settlement says your spouse is going to pay off certain accounts, either cut a deal and get yourself off those accounts, or make sure you're getting those bills as well every month, make sure those are being paid. Don't just assume that he or she's making the payments, because 2 years down the road you're going to be a world of hurt if you don't keep on top of it.
That's great advice. Well, I don't see any other questions, and I really appreciate your attendance this morning at our webinar, and please tune in for some of our other webinars. Thanks again.